All right, well, we'll go ahead and get started. Good morning, everybody, and welcome to Maynard Costerisan's 2024 GASB Update webinar. We're so glad that you're here. Today, we will be sharing important GASB updates for schools and how these changes affect your school's financial planning and reporting strategies. Thank you all for joining us today. A few housekeeping items. This session is being recorded and everyone is muted. If you have any questions, please type them in the chat and we will have time at the end to answer those. And with that, I would like to welcome Jeff Straus and Kasey Roth to today's session. Jeff is a principal in the audit department and a member of the firm's board of directors. He specializes in providing audit services to Maynard's education and nonprofit clients. Kasey is a senior manager in the audit department and works closely with the firm's telecommunications, education, and nonprofit clients. Thank you both for taking the time to share your knowledge today. Jeff, I will go ahead and turn it over to you.
Perfect. Thank you, Cheyenne. Glad to have all of you guys here this morning. We've done this, I think, for the third or fourth year, Kasey, where we've just like to get in front of all of you and just give you some of the information that's really pertinent, not only to this year's audit, but even coming up for the upcoming audit for the 23-24 year. As Cheyenne mentioned, we are referring this in a way as the GASB update because if you recall the past few years, we've had a lot of GASB standards that have kind of come down the pipeline that have had to be implemented over the last few years. This year, for our 23-24 audit, fortunately, though, we're looking at something different than what we've seen in the past. We do have some GASB updates, but we really have no new standard that's really dominating the headlines this year. The biggest one is going to be GASB 101, which is really going to be more of an impact for next year. So even though we do want to take some consideration in for what GASB 101 is and how it's going to impact the district next year, it's really not a two-day issue. It's more of a issue that we want to identify and make sure we're getting ahead of for next year's audit. So looking at the agenda, you can kind of see what we have in front of us. We implemented both 87 and 96 for all of our districts over the past 2 years. The real big thing to take away from this slide deck today is that this wasn't a one and done type GASB standard. We are going to have new leases that we enter into. We're going to have new subscription-based IT arrangements that we're going to enter into. And the accounting for that is still going to impact both your fund level financial statements and your full accrual financial statements. And Kasey's just going to go through and give us a little bit of a refresh on both GASB 87 and 96. After that, I'm going to go through the aforementioned GASB 101 portion. And then Kasey's going to give us a little bit of an update on some of the changes on an auditing standard that we have to consider, and that's SAS 145. We're really bringing it up at this presentation because you probably are going to have some additional questions that are coming from your auditors during prelim, during final, that really look at the IT side of things and the controls that you might have in place just from an overall risk assessment on the audit side of things. Kasey's going to continue going into the bond and sinking fund audit. There's some changes that are going on there, mostly for the better, and just give you a little bit of an update on that piece. And then I will go through some of the accounting and information on the student loan forgiveness piece at section 27K, as well as a few wrap up other consideration items at the end. But to get us started with the actual presentation, I'm going to kick it off to Kasey Roth. Thanks, Kasey.
Hello, as Jeff mentioned, I'm Kasey Roth, and we're going to jump right into GASB 87 and 96. As many of you know and are probably tired of hearing about, GASB 87 went into effect 2 years ago for year ends June 30th, 2022, and that encompasses lease arrangements. 97, the newer, or 96, the newer of the standards, encompasses SBITAs or subscription-based IT arrangements, and that went into effect for last year's audits or 6/30/2023 year ends. For this sake of this presentation, because they were already in effect, we're going to kind of encompass them as one, as much of the accounting is similar. So for both standards, they are eligible to short-term exemptions. What this means is if your lease is 12 months or shorter, without extension periods, you may be exempt from having to implement 87 and 96. We see this mostly for year-to-year arrangements that don't necessarily have renewal terms. Even if you planned on renewing it, if it's just a year arrangement, doesn't state anything about a renewal term, you do not need to implement 87 and 96. But the big thing is you'll have to work with your auditors and look at the contracts to really determine that. So year to year, month to month, likely can get out of 87, 96. I'm sure many of you have already dealt with this and taken this exemption. That's one of the perks of the GASB standards. So one thing we really want to keep in mind now that these standards are implemented, as Jeff said, they are implemented, but they are continuing requirements going forward for them. So the big thing you want to look out for are, do you have any new leases or SBITAs in the current year? Because if you do, you need to record that full amount as a capital outlay and an other financing source in full. So it could be a pretty big number. While this has no net fund balance effect, it is important to budget for that. You wouldn't necessarily be out of compliance, but you would see a big spike in expenses, a big spike in other financing sources. So many clients do like to budget for this. So typically when we're with our clients at pre-audit, that is one thing we try to touch base with before that final budget is due, is should you throw an amount in capital outlay and other financing sources for new leases or SBITAs. For lease modifications, so let's say you have a lease that got extended or terminated early. We didn't account for that when you initially recorded the lease. What you're going to do here, and the auditors will likely help you here, is you are going to reassess the lease liability on the government-wide, and then you would push the change through the right of use asset. So might not have an effect on your fund level, but it is something to keep in mind if you do modify a lease. If that lease asset or SBITA asset does go down to zero and the lease liability does too, you could have a little bit of a net income effect on the government-wide because the change would have to be pushed through there. So how are we going to track these going forward? Much of like what I said, we need to just pay attention to new leases or SBITAs and make sure they're recorded correctly in full on the governmental funds for the first year. And then going forward, you should be tracking the payments for these leases and SBITAs with a principal and interest component down with a debt service function and object code. What we see a lot of districts and academies do here and other governmental units is they might track lease payments as they historically have under just the lease expense, but then maybe at the year end, make a journal entry if you didn't want to track your principal and interest throughout the year. So sometimes it's kind of tricky about what that interest piece is. So that's what we see a lot is just the lease expense being recorded through the year and then make it kind of a reclass near year end to make sure that it is accounted for correctly down in that principal and interest component. So I pulled this example directly from MD's accounting manual guidance, and this is just an entry that shows how to record an initial SBITA. This one, like I said, is a SBITA, but accounting is similar to that of a lease. So if you look at that top entry for the governmental fund, they recorded a full capital outlay for $100,000, which would be the total of that package over the allocated amount of years. And then they recorded that other financing source for that $100,000. Down below is the government-wide entry, in which the amount from the expense is moved up to a right of use asset. And the corresponding $95,000 is put as a liability. This one's a little different because there was $5,000 paid up front. So that asset doesn't necessarily match the liability on the government-wide side. This next slide here is going to show what we would expect the entry to be year to year once cash is paid for the first year. So as you can see, as I mentioned in the previous slide, there is a principal component of $30,000 and an interest of $1,000. So the cash out the door is $31,000. So the big change is historically what you would have recorded as a SBITA or lease expense just in total of the 31,000, the new standard does require that principal and interest piece to be broken out. That bottom piece is on the government-wide side. The asset is then amortized over the useful life or contract of the SBITA. And then the liability is reduced by the payment for principal each year, much like debt. So that is just a brief overview of the GASB 87 and 96. We didn't go too far into it just because we've done this for multiple years, but there are slides and guidance here. And as always, we recommend reaching out to your auditor or accountant if there's any questions or concerns there. So I will pass it over to Jeff for compensated absences.
Yeah, thank you, Kasey. And I know we are kind of all tired of hearing about GASB 87 and 96. Seemed like GASB 87 was going to be a huge deal when it first came out, then it ended up not impacting as many of our districts as we thought. Then when the SBITA standard came out, we did see a lot more districts being impacted by that standard. We did have a handful of districts, though, that really didn't initially see an impact, but they probably will in some of these upcoming years. So this really could be information that some of our districts are going through and kind of seeing and having to deal with as far as the implementation side of it for the first time going into this 23-24 year. So thank you for that, Kasey. And it's going to be useful to have that information available for the districts to take back. The big one that's coming down here, and I think I said earlier for the 23-24 year, but it's actually for the 24-25 year, is GASB 101, which is really giving a refresh to GASB 16 on the whole compensated absences thing. A couple of bullet points over here to the left, just hit them on an overall highlights because they are changes that you'll see within the statements to some extent. So that first bullet point, all it's really saying is a lot of times we've had a number for compensated absences. We've shown what the additions were, and then we've also shown what maybe the usage of that compensated absences were within that long-term obligation footnote that we would have had within your financial statements. We are allowed now, and we'll be moving forward, just having a net change number on the financial statements. So we no longer really need to keep that separate as far as the gross up of the adds and the gross up of the deletions from that liability for compensated absences. And historically, we'd want to identify which fund was maybe paying for those liquidated compensated absences. That's also a requirement that's not going to be necessary anymore. So just 2 bullet points. But GASB 101 is getting a lot of headlines right now because for some of us, we're looking at the government-wide financial statements, and it's not really a statement that a lot of the readers of financials put a lot of time into reading. It is looking at a liability that is out there, but it's clearly an estimate. And when we think about GASB 16, we're really thinking about what that sick time or that PTO number was that is going to be estimated as far as being paid out largely at what that termination rate would have been. So when we get into what a compensated absence is and how we're changing from GASB 16 to GASB 101, it's important to understand like what we are defining as a compensated absences. A lot of it is going to stay the same for what we saw within GASB 16, but we do have a little bit of a expansion on what is going to be considered a portion of that compensated absences pool from 101 compared to GASB 16. So mostly we're looking at those top 2 points that left. So when we're looking at compensated absences, those are going to be cash payments when the leave is used for time off. So that's looking at when a person is employed and they take PTO, we're going to want to be capturing that within this calculation. The other piece is historically what we've seen a lot is those cash payments that will be likely or what was probable to be paid out upon the termination of employment. So those are the 2 big ones that we're going to be looking at. But if there were any non-cash settlements, you can see some examples right there on that defined benefit, post-employment benefits. We might need to consider those as well. But mostly we're going to be talking about those top 2 points, either amounts paid off during the term of employment or amounts that are anticipated or more likely to be paid out upon termination. The examples you can see below, they are trying to expand what would be included within that compensated absences, I guess, pool, or that maybe wouldn't have been considered in the past. Your vacation, your PTO, your sick, all of that is going to be consistent with what we've seen in the past. But in a world that's changing to be, I guess, a little more agreeable to some of this time off, you see we have parental leave, bereavement leave, sabbatical leave. All of those could be considered within this calculation of compensated absences as well. The one caveat to some of those, you're not just going to book a liability there because somebody might take that type of leave. You're really only going to book those types of leaves within the calculation if there has already been a commitment to take off that parental leave or that bereavement or sabbatical, and it's more of a known than a guesstimate, I guess. So why the change? Some of it I've already talked about, but really it's trying to capture what that real number would be. So historically, we've calculated it for a lot of our districts on what that termination payout percentage would have been. A lot of times that might have been 50% of the pay. Now we're going to be looking at it from both a estimate of what the amount that will be carried through all the way to that termination payment and what amounts might be used up during the term of employment or while the employee is working. But it's also to capture the new kind of leave types that we're seeing in the world today. So trying to be a little more expansive and give a little more accuracy within what a compensated absence liability could look like, rather than being a little bit dated like GASB 16 was. Some of the biggest changes that we're seeing, which will likely impact your liability, you can see in this kind of graph or the shift in percentages down below. Within GASB 16, we were really living in this, is it probable? And probable is a very subjective term, but when you look down here, you can see that probable was probably somewhere in the 80% or more likelihood that an employee was going to take that benefit. That shifted a little bit down to probably more in this 50% likelihood, or this more likely than not category, which is going to have a broader impact on what that value will be. And more likely than not, 50% is obviously going to encompass a greater percentage than what probable would have. So we're probably going to be seeing a overall increase in those liabilities, just because we're now looking at something in a more likely than not lens instead of a probable lens. Little comparison on the concepts between GASB 16 versus GASB 101. I've really mentioned a lot of these already, but you can see the big difference right here within GASB 16. Maybe less of a broad spectrum as far as what they were considering PTO or compensated absence within their categories. But the biggest portion is we were looking at the vested portions, and we were looking at the non-vested, but it was all based on this probability of being highly probable that someone is going to take that leave. GASB 101 changes that. One, it changes the category or the time off categories to be more expansive, but it also changes us from this probable situation to that more likely than not. And that's really the biggest impact between the two. And as you go through this process within your district, you're really going to want to probably be somewhat granular as far as the employee types, vested or not, and really try to determine what those percentages look like as detailed as you can, so that your calculation can be as specific as possible. So you're going to want to break it out by employee type, by compensated absences type, and by vested or non-vested to really come up with the most accurate calculation as you work through GASB 101. So measurement, I've mentioned it a couple of times. A lot of times we've been using 50% because a lot of our agreements that we see out at districts would have said this PTO or compensated absence is going to be paid out at 50% of their rate upon termination. But And that can still be accurate to some extent with how we're doing it, but it's going to be in this exception type piece like we're looking at below within the bullet points. The measurement really should be the employee's pay rate as of the year end that we're talking about. So this is going to be June 30, 2024, unless we're categorizing it within one of these exceptions, with that main one being, is it going to be paid out at the end of a employment, to where it's only going to be at that half pay rate because that's what their agreement states. There could be other settlement type situations that might happen as well, but really we're going to see this measured at either A, the full rate of the employee's compensated absence from a overall pay rate standpoint at the end of the year, or it's going to be at that adjusted portion because that's been contractually determined and we're identifying it as being paid out at termination or retirement. The details in front of you right here really relate to an example that we'll go through on the next page, but putting a couple of assumptions in here. So we are identifying that 50% payout that paid out after 5 years of service. So that's going to be our vested employees that we're talking about in our 5 years, because in this example, we're looking at a vesting period of 5 years. And we're basically determining that the entire pool that we're talking about, this $1.2 million, that's our vested employee pool. We're then looking at our non-vested, less than 5 years of service, and their current pool would be at that $1.4 million. So overall, we're looking at $2.6 million in 100% compensated absence number if we didn't apply any of our calculations to that. Obviously, we're going to reduce that based on historical information and what we think is going to be the actual liability, but that's where we're coming up with those two different pools right now from a vested versus not vested. That point at the bottom is also saying it's attributable to services that have already been rendered, and that's because we're not projecting this liability out for future amounts. It's really, this is where you are out of June 30. And even though the liability is going to be for some of those future pieces, we are accumulating those for services that have already been rendered. And that's where the 5 years vesting period kind of comes into play. The two columns here that you can look at, one relates specifically to GASB 16, and the other relates to how the same calculation with the assumptions that we're going through would work for GASB 101. And the bottom number, you can really see the impact within this example on what GASB 101 is going to have. And by and large, we do expect that overall liability to increase. I'm not sure if it's going to double. I think we're up $715,000 from where we were on GASB 16 to GASB 101. I don't know that that's always going to be our increase, but the overall thought process would be that this liability is going to go up. So within the current model, GASB 16, that $1.2 million that we identified on the previous slide, we're estimating that 50% of that is going to be paid out. That's where we have that $600,000 number. For the non-vested portion, the probable piece of that is that 25% of that 1.4 will actually get to that period where it'll ever be paid out, and then it'll be paid out at that same 50% rate. So we're combining that $600,000 calculation for the vested portion with the projected non-vested portion, the 25%, also applied at that 50% rate for that $175,000 to get us to an overall liability of $775,000. Relatively simplistic as far as how that calculation was completed. But when you look at GASB 101, it does get a little more complex. The top section for the vested and the bottom section for the unvested, we're using that same base pool amount, that $1.2 million for the vested portion and that $1.4 million down below for the unvested individuals. And when you look at this, you now need to make an assessment at how much of that vested portion is going to be used up during employment. And in this example, it was determined based on historical trends analysis that the organization would have completed, that 80% is going to be carried all the way to termination and be paid out at that 50% rate. And the other 20%, so for a total of 100% of the population, is going to be used up during their employment term. So when you do that calculation, you can see $480,000 is what we're estimated to be paid out at termination when all of these employees end up ultimately retiring and the other or leaving the organization. The other 20% of that $240,000 is going to be where we see most of our increase, because that's no longer being reduced by that 50% payout rate. And we're actually estimating that it will be paid out at the full rate and not the reduced 50% rate. So right there, we can compare the $600,000 number that we calculated within GASB 16 to a number over here that now calculates out to be $720,000. Now that's just the vested portion. On the unvested portion, you can see we do similar calculations. So in this instance, we're basically saying 30% of the balance is more likely to be paid out for employees staying on for more than 5 years and will receive the termination payment. 40% is going to be paid out during the employee's term as being employed by the organization. And 30% of those unvested employees aren't going to stay to that 5 years, and that portion is going to be fully forfeited. So still getting to that same 100% of that overall balance for that pool of employees, but we're only using 70% in the calculation. And then we're applying the same procedures that we did up above on the vesting side of things, but we're only doing for 70% of that. So of that $1.4 million, 30% are going to stay all the way to their termination, retirement after they're vested, and they are going to get paid out, but at that 50% rate. So that's how we're coming up with that $210,000. And another 40% of those employees, again, based on some of the historical information that the district has accumulated as far as coming up with these percentages, would have determined that $560,000 of that $1.4 million will be paid out, but it's going to be paid out during that employee's employment term prior to retirement. So that's making that amount go all the way up from our previous calculation of $175,000 up to about $770,000. So almost $600,000 increase based on that analysis and those specific parameters within that calculation. And that's how we're overall going from a $775,000 liability up to an almost $1.5 million liability. So again, that might be a little bit of a steep increase, but we're trying to exaggerate the impact of what this example or what this standard could have throughout this example. And we would expect these liabilities to increase over the terms.
We do have a question, Jeff, from
Sure.
Daniel. How close is Maynard Costerisan looking at 101 relative to materiality? And we do use materiality for all of our testing of 101. I think the main thing we're going to be looking for is some sort of analysis by our clients. We need to see some sort of thought going into what percentages are going to be used and why they're going to be used. But materiality for the audit will play an effect. And then part 2, we just posted. So what he asked here is that from his experience that GASB 16 is a few $100,000. He's not sure how much 101 will play in effect. And I know me and Jeff have had this conversation as well. Depending on what the district, academy, or governmental unit is doing, I agree it may not have had, might not have an effect, and Jeff can speak more on that.
Yeah, I think really it all comes down to what those contractual terms are and what that termination percentage is. If it's a significant and we've been estimating it at 50% for your whole liability, and we know some employees are going to use up some of their time off throughout their term of employment, there's going to be probably an increase, but materiality is always going to play into it. And if we have reasonable estimates that can kind of point us into the direction that, yes, the change isn't going to be material to the statements, that's always going to trump any need to actually show the standard anything different than maybe what we've been doing in the past. We still need to implement the standard, but what that change is may not require a lot from a calculation and what we're going to be doing if we can readily determine that it didn't have a material impact on the statements or on the calculation.
And then an
And it's going to be
additional
district.
question
Oh, go ahead.
Was if we were going to provide a roadmap or matrix. I mean, we're still in our early stages of, our analysis of 101. I mean, my thought up front is that we would, at a bare minimum, have a series of questions for the client to fill out, essentially asking what their policy is, carryover effects, and percentages. Whether we do a full matrix, I think we'll
Yeah, I
probably.
think what's going to be really hard on our side of things is we're not going to have that historical trend data. So there probably is going to need to be some digging that's going to happen as far as how do we estimate what that percentage is that was taken during employment versus what was carried all the way to either leaving the organization or retiring. And I don't know that we need to go back a decade, but probably a few years worth of data would be relevant. And maybe it comes out that 80-20 percentage as far as, I mean, how much is going to be used during employment versus carried all the way to retirement might be a pretty accurate like rule of thumb we can go by. But I don't know that we want to just hang our hat on. We're going to go with the 80-20. I think we're going to want a little more information to support kind of the percentages that we're using within the calculation. Because where we see the increase is obviously using the full rate versus some reduced payout rate at the end.
I think we're gonna on the questions for now. We'll keep monitoring them as we go, but
But as Kasey mentioned, I mean, this is going into the next year for 24, 25, but this is a new standard. And what that really means is we're implementing it as a new standard as of July 1, 2024. So this isn't a calculation that we're just looking at to come up with the number as of June 30, 2025. We are looking at that number from a beginning balance standpoint too. So we're going to be wanting to calculate this both as of June 30, 2024 or July 1st, 2024, and June 30 so that we can have that full picture of what the district's impact was. And that's just anything when we ever have a new standard. Same thing that we had to do with GASB 87 and 96. We're not going through the change of estimate side of things. We're going through the change in accounting standard. So it needs to be implemented at the beginning of the period that we're auditing. So the rest of this is kind of a catch-all of what I've already said, but we really just want to probably start working with your team to really pin down what those estimates might look like, probably sooner rather than later, maybe after the audit's done, but I mean, trying to come up with a little bit of some information so that we're not scrambling a year from now, trying to get both the estimate to start the year and the estimate to end the year. And as I had mentioned previously, probably the more disaggregated we can be with the data, the better that estimate's going to be and the better roadmap we're going to have going forward. But as always, reach out to your in-charge partner on your engagements as soon as you can, and any one of them will be able to have a conversation with you about your organization's specific percentages, specific needs, because they're all going to be slightly different. So.
one more question from Dennis, Jeff.
Yep.
It is, what are the accounting and reporting differences for districts who reported compensated absence liability in an internal service fund?
That does change a little bit because I would say reach out to your individual partner on that one because there will be impacts probably at the fund level on the internal service fund, whereas for every other organization that isn't accounting for any of this within an internal service fund, this is only going to be a full accrual government-wide entry. So when you start having to make these changes within that internal service fund, you're probably going to have a impact at the fund level. I mean, you will have an impact at the fund level, but we can touch base afterwards because I don't know how many we have that are actually accounting for it within an internal service fund, and kind of go over a little more of the specifics if that works for you.
All right, I don't see any more other questions related to compensated absences right now, but that really is the biggest thing in this presentation. So if questions do continue to arise throughout this year and next, feel free to reach out to myself, Jeff, or your individual auditors on that. So now I'm going to jump into SAS 145. I'm not going to spend a significant amount of time on this. We did just want to let you know that there was a new statement on auditing standards released, SAS 145. Unless you're an auditor, you don't have anything new you need to do. But we did want to let you guys know because there will be an increased focus on risk assessment for us auditors, which will then affect our clients. So what this means is there is an increased emphasis on risk assessment, primarily in IT controls. So when we're out for prelim or audit, we may ask a few more questions related to your internal IT, what controls you have in place. What we're trying to do is just get a better understanding of the entity's internal controls to determine our applicable risk and if we need to re-risk assess the district or governmental unit. So like I said, nothing you need to do, but you might just wonder, why are they asking so many IT questions or questions that we've historically answered? There is a new statement on auditing, so we just want to make sure we check all of our boxes here.
Yeah, and just to that point, Kasey, it's not any change in how we're determining the risk of an organization. It literally is a standard that is saying, how does the IT within the organization impact the controls of the organization, and trying to close that loop so that you can say, we do have IT is part of the controls, and just trying to integrate that within our analysis and our walkthroughs and the work that we're doing on that side of things to show how that connection is made.
Yeah, so not much you'll see there, just maybe some additional questions. Next, I'm going to jump into the bond construction fund. So just a little bit of history is that bonded construction funds fall under section 1351A of the revised school code. This is for bonds issued after 1994, which are most bonds nowadays. And under that bond audits were normally conducted within 120 days through 120-day audit, as we called it. What that means is that within 120 days of a substantially completed project, you would normally receive a letter from your construction company. You would contact the auditor, and then within 150 days of completion, you would report, turn in a report to the Department of Treasury. What we've seen a lot of districts do here anyway is kind of file an extension. We would submit a little packet separate, but we would do it with the audited financial statements. That audit report would be for the construction period of that bond. So later last year, Treasury number 2023-01 came out, and that just made a few changes to our process. And as Jeff mentioned in the beginning, most of this is for the better. So it did change the definition of a completion date to the later of the certificate of substantial completion, or when the bond proceeds are 95% or more expended. This is nice because sometimes it feels like we're always waiting on the certificate of substantial completion. We don't always get that from the construction side. So sometimes that's actually a little bit trickier to get than it should be. So now your accountant should know when you're 95% or more expended from bond proceeds. So that's a good change there. The other good thing is that you can combine one or more series of bonds into the same report without Treasury approval, which you couldn't do before. And what that allows is if you have the correct disclosures in the financial statements, which I know we do at Maynard Costerisan, you do not necessarily need a separate report anymore. It will be conducted within the audited financial statements as long as there were the required disclosures. As I mentioned, our audit reports typically had those anyway. So coming to that last bullet point, the substantial completion closeout reporting replaced the annual certification letter is replaced by an annual certification letter to be sent by Michigan Department of Treasury. So this is a lot of words, but really what it means is that you no longer necessarily need a 120-day audit with a separate bonded package. It can be wrapped up in the audited financial statements as long as your audit firm has the required disclosures. And then each year there will be a letter sent to the Michigan Department of Treasury that essentially answers some questions on bonds. I know at Maynard we have that letter. We will be sending it. We will be giving it to our clients to fill out. We will submit it with audited financial statements, and then all requirements for this new Treasury letter 2023-01 in the bond and construction audits will be met. So kind of simplifies what was needed. So I know I've had several clients reach out. We're near the 120 audit. Do we need a separate report? Not necessarily anymore, but there will be an additional letter that will be submitted. Moving on to the sinking fund audits. So sinking funds, they're covered under section 1212 of the revised school fund. We do audit these with your audited financial statements. And mainly the things we're looking for under sinking fund audits are allowable expenditures under section 1212. And this audit with your annual audit report, it's combined in there, is submitted to Treasury as well. So there's been some changes with sinking funds throughout the years. So prior to March 29th, 2017, there was just one type of sinking fund. It fell under there. There was one packet of allowable expenses. After March 29th, 2017, they essentially expanded what is allowable in the sinking fund. So if you had a sinking fund fall between those periods and you included that updated language in your sinking fund ballot, then you essentially had expanded your allowable categories. Well, now, starting after May 7th, 2023, there is now more allowable things under the sinking fund. Those new allowable uses are student transportation vehicles, trucks, and vans. So what we want to really stress is when you have a sinking fund, you need to know what type of ballot language was used. Was it the language used prior to 2017? Was it the 2017 through 23? Or was it after the 2023? The dates are important, but what's more important is what was used in the ballot language. So let's say in 2024, you're renewing your sinking fund. Our recommendation would not be to copy and paste your last sinking fund ballot. It would be to update it so that you can now use these new allowable categories within your sinking fund. And when we're testing that, we're going to be paying attention. As I said, there's sort of three separate buckets of what your allowable expenditures are. Our recommendation, as I already mentioned, is if you have a new one, use the most up-to-date language. That will expand your allowable buckets to the full extent there.
All right, I will kind of carry us into the student loan repayment program. So mostly what I'm going to focus on here is the accounting. I know if you're a district, you have been deep into the weeds on what this whole program looks like. I think the general assessment was this is great for the teachers. They didn't really have to run through the schools because it's been a labor-intensive, tedious process to go through it all. But you can see what a lot of the terms and parameters of the program is. So again, talking about this Section 27K funding that's coming in through state aid. The program ran or is running from October 1st, 2023 through September 30, 2024. That creates a little bit of complexity within the audit side of things because obviously we're doing our audit as a date of September 30, 2024. So some of the information or some of those payments aren't necessarily going to be impacted by the current year under audit, and we're going to have to account for those in a very specific way. The big portion is really how do we account for the dollars that are coming in, and the $200 and the $400 is really coming from which area the district is located. Are you in that band 6 or not to get that 400? Otherwise, you're probably going to be in that $200 range for each of your employees that are eligible, working directly with students, would likely receive a maximum of that $2,400. Districts, you're going to need to make sure you're calculating based on the criteria who is eligible to receive this payment. The one other piece that I'm going to go into is not every teacher is going to have a $200 per month payment, and there is going to be an impact if the actual amount that the teacher is paying within their loans is less than $200. Then there's also going to be kind of an impact on how we account for that as well from an audit perspective. Right now, what we're hearing is we're probably going to start seeing those payments. 10 out of those 11 payments come in during July, with maybe that final payment coming in August. A lot of what we're talking about right now is all based on that assumption that we're going to get those payments within the July and August state aid status payments for it to impact this current year. If by some reason these payments don't come in within the July or August payments, and we're now looking out to that October state aid status payment, all of what we're talking about right now doesn't impact anything, and it's going to be a 24 or 25 issue, not a 23-24 issue. But right now we are anticipating that's all going to start coming in during July and August, and will need to be accounted for this year. Districts likely are going to start paying once some of that funding comes in during June and August, or July and August as well. The piece that I was talking about before is really the timing of the program versus the year that we're auditing. So because the program runs October 1st through September 30th, 3 out of those months really aren't going to be captured within the accounting period that we're auditing, or the fiscal year, June 30, 2024. So we're only really looking at 9 months worth of those expenses, no matter what, as long as these payments are coming in during July and August. And we're not going to be taking those July, August, or September payments and expensing them for the 2024 fiscal year. So that's the first biggest impact. We'll book a receivable for the full amount, that $200 times the number of employees times the number of months, and come up with that number. You're going to receive the full $200 for every employee for all those months once that final payment is actually made. So that receivable is going to be a pretty known number. The revenue coming in is where it's going to get a little bit challenged, because you're only going to be expensing amounts that are eligible to be expensed. So it can only be up to that $200. It can only be the 9 months, not the 3 months that are going to happen during July, August, and September. And if you have any employees that didn't expense a full $200, maybe they were at $150 per month, that $50 gap between the 150 and the 200 also won't be able to be expensed. So where does that offsetting part of that entry go? It's going to be sitting in an unearned revenue number within your liabilities. So that's going to be the biggest challenge there. We're looking at only the 9 months, and then only the amount of expenditures that were actually paid out on a loan payment. And if you're curious on what grant codes, object codes you're looking at, those are going to be 273 and 2390 for the object code. So here's a little bit more information, but really all that I already just said. I mean, you are going to receive that full 200, only pay out the amount of the total loan payment. So if it wasn't all the way up to that $200, you're not going to get to that same point. This is where the tedious challenge for districts really came in. You can see that starting here. Districts will need to have a tracking reconciliation process for each employee's individual payment to really come up with what that unearned portion of the revenue is going to be. I know some districts have paid a third party to kind of go through this whole process for them. Some of them have done it in-house. Again, I don't think the overall tracking is all that complex, but it is tedious, time consuming, all of that, and part of the reason why districts have kind of made that determination one way or the other. On the taxability side of things, so this gets a little bit challenging because we don't know all of the other amounts that maybe an employee has been received, but there is that limitation of $5,250 per employee. But before we even get to that point, the district must have the qualified Section 127 program in place. Hopefully you have that language, all of that going down, so that if it was even going to be considered non-taxable at all, that's already there. For the employee side of things, you're looking at that threshold of 5,250. So either way, with the 200 or 400, you're probably not getting to that point, or you wouldn't be getting to that 5,250. But if there were other amounts that were going to the teachers or the employees that were receiving these benefits, and you got up over that 5,250, anything over that 5,250 would be taxable. So if you were at 6,250 in total amounts that were coming through to them or repayments, $1,000 would be taxable. So just something that the teacher should be aware of, but I don't think it should impact a lot of our districts, really. That's all I had on the 27K stuff. I know it's been really hit on pretty heavy. If you've been at any CPE or anything related to MSBO, you probably would have heard about that quite a bit.
Good question, Jeff. Dennis is asking if we don't receive funds until FY25 state aid,
Yeah.
the district doesn't need to record an expense or liability related to the revenue and due to other governmental funds at 6/30/24. Is that correct?
Correct. Yep. It's a little bit of nuance. I don't think we're going to fall into that, like that scenario, but that would be the case.
Perfect. I don't see any other questions regarding
Yep.
27K.
I've got 3 more things just to hit on, and all of them are kind of down the line, except for the arbitrage one, which was impacting last year as well. And I'll hit on all of them, but just nothing too lengthy on any of these items. Some great news we've heard about. I think even when the threshold a number of years ago went to 750, there was some talk even then about the threshold for a single audit in receiving federal funds might have gone to 1 million at that point. We are going to see that threshold increase in the upcoming compliance supplement to that $1 million. Unfortunately, that's a year out for all of our school districts. But we're going to see that really impact the June 30, 2025. So with most of the ESSER money being spent during this 23-24 year, and then the increased threshold going into 24-25, I would imagine many districts that were kind of right on that cusp are probably going to be falling out of the requirement for needing a single audit for that 25 fiscal year. The new financial reporting model, this is even further out than that, probably 26, maybe fiscal year 27. When talk first started coming out on what the financial reporting model was going to look like, it was almost like a revamping of GASB 34. A lot of that throughout the process of deliberations has really fallen by the wayside at this point. But one of the big things for districts as we go through this over the next 3-4 years to really be aware of is they're trying to get a little more information pulled out of the MD&A, maybe moving away from redundant information being reported within that MD&A and shifting some of that information on a variant side of things into RSI or required supplementary information pages. So we already have your budget to actual within the RSI, but if there are significant variances, sometimes we would have identified those within the MD&A. Again, we're still talking a few years down the road, but they're going to be likely wanting to see some of that analysis being part of the RSI pages if you have significant variances, which I don't know that I have a determination on what that percentage or dollar would look like, but just something to have in mind as we kind of go down this path over the next few years, as there will be some changes in the financial reporting model, but probably not as significant as we once thought they might be. On the arbitrage things, I don't want to spend a lot of time on the arbitrage, but hopefully everybody's at least aware that you should be reaching out. PFM, I know, does a good job coming up with the calculation. It's really something to just be aware of. If you've had a new bond that's really been passed and you've had a huge influx of cash coming in, sitting in investments that you're probably getting a pretty good return on, you very likely could be having too much investment earnings on those bond investments. And where the arbitrage comes in is you have a rate on those bonds that you're paying from a discount rate side of things. And you're really not allowed to make a lot of money or interest in excess of that discount rate on these bond monies that you've received within the district. And if you're getting too much and you're kind of over that calculation, you could have a arbitrage liability that you'd want to discuss with your auditors. But really, it's reaching out to some of these organizations like PFN that do those calculations that can then do that analysis and tell you what your arbitrage liability would be. And we used to see this a lot back in the I don't know, early 2000s, maybe prior to 2008, 2009. Then we started seeing the situation where interest rates were really low, and they've been low for quite a while, and you weren't making a lot on your investments of these bond dollars. But now that we're seeing interest rates rise, this arbitrage conversation is coming back into play. And some of this information that I'm putting on the screen right now is a little bit old, but you can see the rebatable arbitrage back here when we were looking at this one, it was a negative number. Based on the computation, no rebate liability existed. But if you went through some of these calculations, you would end up in a situation where you could have an arbitrage liability. I've got additional slides in here that kind of discuss what the calculation is, what the definitions are. But when you look at the actual financial statements, you'd really just see it as another liability sitting out here in your non-current liabilities and your full accrual. For this example, it was about $400,000, and then it'd be on your reconciliation down here as well. So just something to be aware of, because we are in a situation where the arbitrage situation has come up a lot more over the last fiscal year and this fiscal year than we've really seen it probably over the last decade. But other than that, Kasey, I don't know if you have anything else to add at this point, but we're very close to time. Appreciate everybody for being on the call today. And if you have any questions, please don't hesitate to reach out to Kasey, myself, or anybody else within the firm. So.
Yeah.
Okay, it doesn't look like we have any more questions. So thank you so much, Jeff and Kasey. And thank you all for joining us today. Tomorrow, Friday, May 17th, we will be sending out an email recording of this presentation. So Jeff and Kasey's information will also be in the email. If you have any additional questions there, feel free to reach out. And thank you all, and we hope you have a great rest of your day.